This CTA screencasting project is supported by the South African Institute of Chartered Accountants and the Auditor General of South Africa via the Tutuka program. As part of discussing IFRS 15, I will focus on the 5-step revenue model. Each step will represent a separate screencast. In the second screencast, I will now discuss the second step of the revenue model, identify the performance obligations in the contract. At contract inception, an entity shall assess the goods or services promised in a contract with the customer and shall identify as a performance obligation each promise to transfer to the customer either a good or service or a bundle of goods or services that is distinct, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. When will a series of distinct goods or services have the same pattern of transfer to the customer? If both of the following criteria are met. Each distinct good or service in the series that the entity promised to transfer to the customer would meet the criteria to be a performance obligation satisfied over time. When a performance obligation will be deemed to be satisfied over time will be discussed in Screencast 5. And secondly, the same method would be used to measure the entity's progress towards complete satisfaction of the performance obligation to transfer each distinct good or service in the series to the customer. A contract with a customer generally explicitly states the goods or services that an entity promises to transfer to a customer. However, the promises identified in a contract with a customer may not be limited to the goods or services that are explicitly stated in that contract. This is because a contract with a customer may also include promises that are implied by an entity's customary business practices, published policies, or specific statements. If at the time of entering into the contract, those promises create a valid expectation of the customer that the entity will transfer a good or service to the customer. Let's look at an example. An entity has historically provided maintenance services as part of the contract to the end user at no additional consideration. The contract does not explicitly promise the maintenance services, nor is the terms and conditions of these services defined. Are these maintenance services a promise to provide services to the customer? Yes, because the entity's customary past business practices have created a valid expectation with the customer that these services will be provided. Remember that a good or service promised in a contract can only be a performance obligation accounted for separately if it is distinct. Thus the question is, when is a good or service promised to a customer distinct, if both of the following criteria are met? Firstly, the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. The customer can benefit from a good or service if the good or service could be used, consumed, sold for an amount that is greater than scrap value, or otherwise held in a way that generates economic benefits. For some goods or services, a customer may be able to benefit from a good or service on its own, and for other only in conjunction with the other readily available resources. A readily available resource is a good or service that is sold separately by the entity or another entity, or a resource that a customer has already obtained from the entity, including goods or services that the entity will have already transferred to the customer under the contract, or from other transactions or events. The fact that the entity regularly sells a good or service separately would indicate that a customer can benefit from the good or service on its own or with other readily available resources. And secondly, the entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. Factors that indicate that an entity's promise to transfer a good or service to a customer is separately identifiable include, but are not limited to, the following. The entity does not provide a significant service of integrating the good or service with other goods or services promised in the contract into a bundle of goods or services that represent the combined output for which the customer has contracted. Thus, it is not used as an input to produce a combined output to the specific customer. The good or service does not significantly modify or customize another good or service promised in the contract. The good or service is not highly dependent on or highly interrelated with other goods or services promised in the contract. For example, The fact that a customer could decide to not purchase the good or service without significantly affecting the other promised goods or services in the contract might indicate that the good or service is not highly dependent on or highly interrelated with those other promised goods or services. Let's look at an example regarding the identification of performance obligations in a contract. A contractor enters into a contract to build a hospital for a customer. The contractor is responsible for the overall management of the project and identifies various goods and services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. The contractor regularly sells each of these goods and services separately. Discuss whether the promised goods and services to be provided in terms of the contract are distinct. The customer can benefit from the goods and services either on their own or with other readily available resources. This is evidenced by the fact that the entity or competitors regularly sells many of these goods and services separately to other customers. In addition, the customer could generate economic benefits from the individual goods and services by using, consuming, selling, or holding those goods or services. Thus, the first criteria of IFRS 15 paragraph 27 is met. The entity who provides a significant service of integrating the goods and services, the inputs, into the hospital, which represents the combined output for which a customer has contracted, in terms of IFRS 15 paragraph 29a. Thus, the entities promised to transfer individual goods and services in the contract are not separately identifiable from other promises in the contract. The second criteria of IFRS 15 paragraph 27 is not met. Because both criteria of IFRS 15 paragraph 27 are not met, the goods and services are not distinct and should all be accounted for as a single performance obligation in the contract. The illustrative examples number 10 to 12 in Part B of IFRS 15 provides additional examples on Step 2 of the revenue model, identifying the performance obligations in the contract. In the next screencast, I will discuss the third step of the revenue model, determine the transaction price. Thank you for your time and good luck in your preparation for the test.